Welcome back to the Daily Crypto Deep Dive. Today, we need to talk properly about Iran, oil, Bitcoin, and the wider crypto market, because this is one of those moments where the market feels tense, but a lot of people are still trying to work out exactly what is driving the pressure. The easiest way to understand it is to ask three simple questions. Where were we before all this started? Where are we now? And where might we go next, depending on what happens from here? Because this is not just a story about war headlines. It is a story about how geopolitical risk pushes oil higher, how higher oil affects inflation, how inflation affects the Federal Reserve, and how all of that feeds back into Bitcoin, Ethereum, and the wider crypto market. Before we go any further, a quick word on Kraken, now the official partner of the show. We are genuinely pleased to have them on board because Kraken is one of the biggest and most established names in crypto, and that makes this a natural fit for what we do here. If you have been thinking about where to buy, sell, or manage your crypto, you can check them out through our link in the description. It supports the show, helps us keep building, and it is always appreciated when the community backs the partners that back us. For a limited time, we will be giving people who use our link to sign up 20 XRP into their new Kraken account, so don't delay and message us on X when it's done. Now let's start at the beginning of this latest phase, because the context here matters. Before the strikes, and before Iran became the center of the market conversation, Bitcoin was already in a vulnerable position. It was not in free fall, but it was not exactly full of momentum either. Then the military escalation began, and the market had to start pricing in a much bigger kind of uncertainty. This stopped being just another regional tension story and became a story about whether one of the most important energy routes in the world could be disrupted. And the moment traders started thinking seriously about the Strait of Hormuz, the whole market shifted. This was no longer just about crypto. It became a global macro story. That is the key point people need to understand. When you hear about strikes, retaliation, and threats in the Middle East, it can sound like a completely separate world from your crypto portfolio. But once oil becomes part of the equation, it is absolutely connected. Because Bitcoin does not just trade on crypto-native news. It also trades on liquidity, inflation expectations, interest rate expectations, and broader market risk appetite. So when oil becomes the transmission mechanism, a war in the Middle East can quickly become a major driver of crypto prices. So where were we before all this? When the first real shock hit, Bitcoin fell below $64,000. That was the immediate market response. Traders saw danger, uncertainty, and the potential for wider instability, and they pulled back. That move made sense. It was a classic first reaction to geopolitical escalation. Risk came off, and crypto felt it straight away. But what made this whole period so interesting is that the story did not end there. Bitcoin did not simply collapse and stay there. Instead, after that first wave of selling, it stabilized, recovered, and then pushed significantly higher in the weeks that followed. At one point in March, Bitcoin traded back up toward the mid-70,000s, around the $76,000 area. And that is a very important part of the story, because it tells you the market did not treat Bitcoin as a simple casualty of war panic. In fact, for a while, Bitcoin looked far more resilient than many people would have expected. That rebound forced traders and analysts to ask a bigger question. Was Bitcoin showing genuine strength through a geopolitical crisis, or was the market simply swinging between fear and hope without ever fully committing to one view? That debate is really what defines this whole period. On one side, you had the more bullish case. That argument said Bitcoin's rebound showed the asset was maturing. It suggested that Bitcoin was no longer just a fragile risk trade waiting to fall apart every time the world got messy. Supporters of that view would say that in a period of war risk, political instability, and rising uncertainty, Bitcoin still found buyers and still recovered hard. That is not what a broken asset does. That is what an asset with real underlying demand looks like. But on the other side, you had a much more cautious interpretation. That argument said Bitcoin was not behaving like a safe haven at all. It was simply reacting to changing macro conditions. When the immediate panic cooled, Bitcoin bounced. When traders started thinking the worst-case scenario might be avoided, Bitcoin bounced. But every time oil reasserted itself as the main story, the pressure came back. And that is why this market has felt so difficult to read. Bitcoin has looked strong enough to avoid collapse, but not strong enough to fully escape the gravity of the macro environment. That is really the tension right now. A geopolitical shock like this can create two very different stories for Bitcoin. One story says instability makes a borderless, non-sovereign asset more attractive. That is the more idealistic Bitcoin case. In a world that feels more uncertain, something outside the traditional system can look appealing. But the other story says a war-driven oil shock is deeply inflationary, bad for central bank flexibility, and bad for liquidity. And if that second story becomes dominant, then Bitcoin stops trading like an alternative store of value and starts trading more like a high-beta macro asset. That is why oil matters so much here. Not just Iran on its own, not even the strikes on their own. Oil is what carries the geopolitical shock into the broader economy. If oil rises sharply and stays elevated, then inflation pressure builds. If inflation pressure builds, then central banks become more cautious. If central banks become more cautious, then hopes for fast rate cuts fade. And if those hopes fade, crypto loses one of the most powerful supports it can have, which is the expectation of easier liquidity ahead. That is why every serious conversation about Bitcoin and this conflict eventually comes back to oil. And that brings us to where we are now. Bitcoin is back around the upper $60,000 area, roughly $67,000. That alone tells the story quite well. The market sold off under $64,000 on the initial shock. Then it recovered all the way toward the mid-70,000s, and now it has drifted back towards $67,000. So what does that mean? It means the market is not in total panic, but it is not confident either. Bitcoin has shown enough resilience to stop the bears from fully taking over, but it has not shown enough strength to convince everyone the danger has passed. That is the emotional state of the market right now. Uncertain, defensive, and highly reactive. Not dead, not euphoric, just stuck in a tense middle ground. And that makes sense, because traders are still trying to answer the biggest question of all. What kind of conflict does this become from here? Does it de-escalate and slowly stop mattering as much? Does it drag on in a messy and disruptive way without fully exploding? Or does it get worse and trigger a much bigger oil shock that starts hitting growth, inflation, and risk appetite all at once? Because if it is the third one, that is where things become much more dangerous. If oil really takes off and stays high, then the entire tone of the market changes. The Fed becomes less likely to ease. Consumers feel pressure, growth slows, and suddenly Bitcoin is no longer trading as some kind of independent digital story. It is being pulled into the same macro storm hitting everything else. That is the risk people need to keep in mind. Bitcoin can look strong for a while, but if the economic consequences become severe enough, it does not get to ignore them forever. At the same time, this has not only been a story about charts, traders, and institutions. One of the most important things these moments remind people is that crypto is used very differently depending on where you are in the world. For a trader sitting at a desk, Bitcoin might be a chart, a position, or a macro trade. But closer to a crisis, crypto can become something much more practical. It can become a way to move money, preserve some value, or get around systems that feel unstable or restrictive. And that is worth remembering, because it shows that the meaning of crypto changes depending on the circumstances. That contrast is one of the most interesting parts of this whole story. Globally, Bitcoin may still be trading like a macro-sensitive asset. Locally, in a crisis, crypto can become a tool. It can become something urgent and useful in a way that goes far beyond speculation. So when people argue about whether Bitcoin is acting like a safe haven or a risk asset, the truth is often more complicated. It can be both, depending on whose eyes you are looking through. That is why these geopolitical moments are always so revealing. They show the gap between how assets are traded and how they are actually used. Now let's talk about the analyst view, because this is where the next phase starts to come into focus. The more constructive camp would say Bitcoin has already handled this crisis better than expected. Their case is simple. The market absorbed the first panic, reclaimed a large part of the losses, and showed there are still buyers willing to step in even during geopolitical stress. They would argue that if Bitcoin can hold the high 60,000s after dipping below 64,000 and then moving towards 76,000, that is evidence of real resilience. And they would add that if tensions cool from here, the market has room to move higher quite quickly because sentiment is still fragile enough to swing hard on any positive change. The bearish macro camp sees it very differently. They would say the market is underestimating how damaging a prolonged oil shock could be. Their argument is that Bitcoin's rebound was impressive, but it happened during a period when traders still believed the war might remain limited. If that belief fades and the market starts pricing a longer, more disruptive conflict, then inflation fears become harder to ignore. In that kind of environment, the Fed does not ride to the rescue, liquidity does not loosen quickly, and crypto starts to look much more vulnerable again. Both sides are looking at the same chart, but they are seeing different meanings in it. The bullish side sees resilience. The bearish side sees temporary insulation. The bullish side sees proof of maturity. The bearish side sees a market that has not yet fully felt the real consequences of prolonged energy stress. And honestly, that is why this is such a fascinating setup, because the next move may not be decided by crypto-native developments at all. It may be decided by headlines about oil, diplomacy, military escalation, and what those things do to the broader macro picture. So where might we go next? The clearest way to think about it is through three scenarios. The first scenario is de-escalation. This is the one bulls want. If tensions cool, if attacks reduce, if the fear around the Strait of Hormuz eases, then oil likely comes back down and the inflation pressure softens with it. That would be a much healthier backdrop for crypto. In that kind of environment, Bitcoin could reclaim the low $70,000 area with more conviction. And then traders would very quickly start asking whether the mid-70,000s, around that 76,000 level, are back on the table. If the war cools and oil relaxes, crypto gets breathing room. The second scenario is a messy stalemate. This may be the most realistic one. Not a clean de-escalation, not a total disaster, just a drawn-out phase where the conflict stays dangerous enough to keep everyone nervous without fully spiraling out of control. In that kind of world, oil probably stays elevated but not completely out of hand. The Fed stays cautious, the market stays twitchy, and Bitcoin likely keeps bouncing around in a frustrating range without delivering a clean trend. In that scenario, the market does not break, but it does not fully heal either. It just keeps reacting to every new headline and never quite finds solid ground. The third scenario is further escalation, and this is where the real downside risk lives. If the conflict intensifies, if energy disruption becomes more serious, and if oil pushes materially higher from here, then Bitcoin likely loses the benefit of the doubt. In that kind of environment, crypto becomes much more vulnerable to a broader macro repricing. The market would stop asking whether Bitcoin is behaving like digital gold and start treating it more like an aggressive risk asset in a worsening global backdrop. And if that happens, then the downside opens up again in a much more serious way. So the bottom line is simple. Bitcoin has done better than many people would have expected after the first Iran shock, but it has not escaped the danger. The market sold the first panic, rallied hard, and is now stuck in a tense holding pattern. If the war cools, Bitcoin can recover toward the low $70,000 area and potentially revisit the mid-70,000s. If we get a drawn-out stalemate, it probably stays trapped in a frustrating range. And if the conflict escalates and oil becomes the dominant story, then the downside risks grow quickly. That is the real state of the market right now. Not broken, not safe, just highly sensitive to what comes next. Bitcoin has shown resilience, but resilience is not the same thing as immunity. And over the next phase, the market will be watching the same set of signals again and again. Oil, escalation, de-escalation, inflation, the Fed. Because right now, that is the chain that matters most. What happens in the Middle East affects oil. What happens to oil affects inflation, What happens to inflation affects policy, and what happens to policy affects crypto. That is where we are. A market caught between strength and vulnerability, between resilience and hesitation, waiting for the next major signal to decide which side wins. Drop your thoughts in the comments, smash like, follow, and we will see you at the top.